Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're digging into uCloudlink's third quarter 2025 results. So, right off the bat, the stock dropped 3.6% after the report. But here's the thing, the headline number was actually a massive earnings beat. So what gives? Let's unpack why the market clearly wasn't convinced. This quarter for uCloudlink was a classic tale of two completely different stories. You're looking at the top and bottom lines of the income statement, and they are just telling you completely opposite things. Okay, so check this out. On one hand, total revenue, down a steep 16% from last year, and it missed what analysts were expecting. But then you flip over to the other side, and wow, earnings per share of 24 cents, the consensus was just 2 cents. That's an 1,100% beat. It's just staggering. So you have to ask, how in the world does that happen? All right, whenever you see a split like that, a big miss on revenue but a huge beat on earnings, you've got to get skeptical. The big question becomes, what's the quality of that beat and what's really driving that revenue weakness? It's time to pop the hood and see what's really going on. So where did all that profit actually come from? This is the very first question any analyst is going to ask. You see a beat this big with a revenue miss, and your mind immediately goes to one place. You start hunting for one-time items, right? Something that isn't part of the core business, something inflating those numbers. And bingo! Here's our answer. Turns out there was a one-time $8.7 million fair value gain on some investments. The CFO even confirmed it in the Q&A. This is basically a paper gain. It's not from their actual operations. So once you strip that out, well, the whole picture changes. You look at their adjusted net income, the real operational profit, and it actually dropped sharply, all the way from $3.7 million last year down to just $700,000 this year. Now that's the number the market was looking at. Okay, so what about that revenue miss? Well, that was pretty much all driven by hardware. Product revenue just plummeted, down 48%. Management was quick to point the finger at two big delayed orders from a key customer in Japan. They blamed it on, the usual suspects, macro headwinds, customers taking longer to pull the trigger. They say the orders should ship in Q4, but it really just goes to show how much they're still at the mercy of these cyclical hardware sales. All right, so let's shift gears and talk about the story management wants everyone to focus on. This is their core narrative going forward. It's all about a big strategic pivot, moving away from that lumpy, cyclical hardware business and building a recurring, high-margin service model instead. And you can really see that transition in action right here. Services now make up over 80% of their total revenue. That's a huge shift from just a year ago. And this change in the mix is precisely why their overall gross margins actually went up to a pretty healthy 53.6%, even while their total revenue was going down. And it looks like this strategy is really gaining traction with users too. Just look at this growth in monthly active users. We're talking explosive triple-digit growth across their new product lines, things like their PetPhone, eSIM, and their other IoT solutions. This is the growth engine they're trying to build for the future. Okay, so let's put it all together. On one side, you've got a low-quality beat and a revenue mess. But on the other, you have this really promising strategic pivot that seems to be working with some fantastic user growth. So what's our take on the stock? Where does it go from here? Well, first, let's look at what they're guiding for. And honestly, it's pretty weak. The midpoint for the fourth quarter suggests we're looking at another quarter of flat to maybe even negative growth compared to last year. And management is still talking about those persistent macroeconomic challenges, which is basically their way of saying, hey, things are still tough out there. So our rating is going to be market perform. Look, the negative cash flow from operations and that weak guidance, those are some serious red flags. But you've got to balance that with the really strong user growth and that clear strategic shift to a much better service-based model. It's a classic show-me story at this point. They need to prove they can execute. All right, now for our final segment, let's talk about a potential trade here, kind of like a plausible pitch you might hear at a hedge fund, all based on this quarter's numbers. So the thesis here is a classic value play. The idea is that the market is punishing the stock for the past, that cyclical hardware miss, while totally undervaluing the future, which is this rapid pivot to high-margin services and all that user growth in new areas like pet tech. So the entry is crucial. You'd want to build a position on weakness, maybe below $2 a share, to price in all that near-term uncertainty. The catalyst to watch for? A major U.S. retail partnership for their PetPhone. Imagine they announce a deal with a Chewy or Walmart. That could be a massive re-rating event for the stock. Of course, the big risk is that the hardware delays continue, the cash flow stays negative, and they just can't figure out how to monetize this fast-growing user base. So that's our take on uCloudlink's quarter. And just a reminder, this is not financial advice.